I'm Marilyn Cohen, President of Envision Capital Management in Los Angeles. We manage fixed income portfolios. That means bond portfolios. My video blog today is really a question. The question is, what great rotation? For the last 9 months or so, market gurus and market mavens have been talking about the great rotation. And what they've meant is that interest rates are so limbo low that everybody is going to rotate out of bonds and bond funds into stocks. But that hasn't happened. I'm not here to tell you it'll never happen, but certainly it has not happened yet. And as you know, timing is everything in all kinds of investments. What we have seen occur is money has come off of the sidelines and gone into the equity market. Money has come out of commodities and gone into the equity market. But bonds and bond funds have been steady eddies. So the question is, how come? How has everybody been so wrong about the bond market? The answer is pretty simple. If you can go online and pick up the Sunday Los Angeles Times, the May 19th LA Times, and look at the cover of the business section, there's a beautiful couple, baby boomers, walking along Redondo Beach, arm in arm, happy as can be. Except during the interview, they say that they're worried sick. They have $1 million and Social Security, and that's all they're living on. And should the Dow Jones Industrials go down to 6,000 again, there's no time to make those losses up. And therein lies the rub, ladies and gentlemen. People know full well that because of the timeline, we boomers don't have the time to live through another 5-year or 8-year bear market in which our money comes back even again. And hence, even though we all know that the bond market is rigged, well, so is the equity market for that matter, with the quantitative easing that the Federal Reserve has done in keeping interest rates so generationally low, we certainly know that someday this is all going to change. But let's not talk about someday, let's talk about today. What should people do? First of all, don't listen to those gurus. You've got to keep a balance of stocks and bonds. I'm a bond maven. I'm a bond market investor. And some of the things that you can buy will give you value for your money in this low interest rate environment. You should be saying, well, Marilyn, like what? Well, for instance, like the PIMCO 0 to 5 years, high yield corporate bond fund. It's an exchange traded fund, symbol H as in Henry, Y as in yellow, S as in Sam, yielding around 4%. So if you want a point and click to get in and out of it, that's all you have to do. Something else that I think will add a lot of value to your portfolio is the Double Line Opportunistic Credit Fund. Its exchange traded fund symbol is DBL. That fund is yielding around 7.3%. Will you be rich by buying either or both of these? Absolutely not. But it sure as heck is better than buying investment grade bonds that are 10 years or less. It's much, much better than sitting in money markets and CDs. Bottom line here, it's not over in Bondland till it's over. So trust your instincts and join me again next month for another video blog.